Okay, so the inflation numbers south of the border, encouraging investors. Let's break down the numbers with Gennadiy Goldberg, head of U.S. rate strategy at TD Securities. Gennadiy, always great to see you. Thank you for joining us. It looks like inflation coming in less than expected, and in fact, the core inflation below the forecast for a fourth straight month.
Yeah, I mean, we've definitely seen inflation come in, I would say, on the lower side of expectations. In fact, it's actually below just about every single consensus forecast. You've seen some weakness in apparel. You've seen some weakness in autos. Lots of weakness really across the board in hotels and airfares. So lots of offsets to a lot of the trade expectations. Now, what I would say is there's still an expectation that inflation is going to rise in the next couple months. So in my mind, this is a little bit of a state of execution for markets. It's definitely encouraging, but it's not necessarily the end all. It's a nice positive number that may not be sustained in the months ahead.
It really does feel like we could be in the eye of the storm here in terms of disruption from the trade war.
Exactly, and you saw the news earlier today that U.S. and China are on track to resume their negotiations that they agreed to in Geneva, 55% tariff rate on Chinese imports. That'll probably still continue to push inflation higher in the months ahead. We'll have to see exactly what that feed-through looks like. But if you look at the numbers today, you do have some very positive offsets, especially some of the longer-term readings like rents and owner's equivalent rents were actually quite a bit weaker than expected. So all of that should continue to contain inflation for now, but we do expect it to rise in the months ahead.
Maybe we could have a look at that old 30-year U.S. bond yield. I know it's kind of a special case. Investors around the world are worried about very long-term government debt. But this could be, we can see yields turning down very, very slightly on the 30-year today. This could be good for bonds, though obviously lower inflation is traditionally great for bond prices.
Exactly. And you're seeing a bull steepening reaction today. So the front end of the curve is really leading the way. You're seeing kind of the 5-year and under part of the curve really lead rates lower. The 10 and 30-year are lagging a little bit, even though they are lower. And part of that has to do with supply. You've got the 10-year auction at 1 p.m. today, the 30-year auction at 1 p.m. tomorrow. And there's lots and lots of worry around the world about foreign investors potentially stepping away. So there's other factors other than inflation actually driving those bond yields.
Well, yeah, you mean concern over government deficits?
Exactly. You've got the One Big Beautiful Bill currently making its way through the Senate. That is the official name. There's lots of concerns about the markup. Our expectation is it will add to deficits quite significantly in the years ahead. We do expect the deal to be done at some point in the next few months. And that is going to be weighing on issuance expectations over the course of the next couple of months. And that's really what everybody's worried about, is that there are just too many bonds out there for investors to take down, especially foreign investors actually decide to step away here, even temporarily.
Is there really a risk that the global appetite for U.S. bonds has been permanently reduced? Well, permanent is a big word, but reduced over the long term because of unpredictability in the White House?
I think there's a little bit of a risk of that. I'm certainly getting that concern from a lot of investors around the world. Mostly, I'm getting more concerns than actual repositioning. I haven't heard of too many investors actually deciding to move away from U.S. debt in a wholesale fashion. Most of them just aren't able to find a deep enough or a large enough market to actually move to, and a lot of them have U.S. dollar mandates. So it is difficult for a lot of these foreign investors to just wholesale move away from the dollar. But at the margin, they could be keeping their holdings a little bit shorter. So not quite going out to 10s, 20s, and 30s. And that actually could drive a little bit of a repositioning in the way the Treasury functions as well. I wouldn't be surprised to see Secretary Bessent come out and at some point in the next few months, if the yield curve is still steeper, if the term premium is still higher, actually suggests that maybe the Treasury is thinking about repositioning issuance towards the front end of the curve. So more bills, more 5-year and under paper than 10s, 20s, and 30s.
That's interesting. I guess they like to have a balanced portfolio of debt out there.
Exactly. And I liken it to almost turning a super tanker. The Treasury really is trying to drive this very, very large market. I mean, we've got 29 trillion of marketable debt outstanding. This is not something that you can turn on a dime. And that's why they do like to have a variable portfolio. But if they see that there is a little bit of a supply-demand imbalance, especially in the 20 and 30-year space, for example, they could decide to reduce some of the issuance out there in the next several quarters and actually ramp up front-end issuance where there's still lots and lots of demand.